Good evening. Or, well, maybe not so good if you were holding silver futures on Friday. If you're watching this, you probably saw the headlines. You likely saw the push notifications, the breaking news banners, or honestly, maybe you just opened your portfolio app and thought for a split second that there was a glitch in the data feed, like surely that decimal point is in the wrong place, right? But it wasn't a glitch. On Friday, January 30th, 2026, the silver market, it just broke. And look, I want to be clear here. We are not talking about a correction. We aren't talking about a dip where you buy the bottom. We are talking about a statistical anomaly, a dislocation event so severe that it effectively wiped out nearly 6 months of gains in, what? A single 6-hour trading window. Silver fell approximately 28% in one session. Just let that sink in for a second. 28%. To find a comparison for what happened this Friday, we have to flip back through the history books. And I mean way back. We have to bypass the COVID crash of 2020. We have to bypass the 2011 highs. We have to go all the way back to the chaotic, smoke-filled trading pits of 1980, 46 years ago, back when the Hunt brothers' attempt to corner the market finally collapsed. Since that day in 1980, silver has never experienced a single-day percentage decline of this magnitude. It is, well, it's historic. And when an asset as large and liquid as silver drops nearly 30% in a day, it isn't just selling, it's a structural failure of price discovery. It leaves investors asking one question. Why? Was it a fat finger error? Some intern leaned on a keyboard? Was it manipulation? Or was it a perfect storm of macroeconomics and market structure colliding at the exact same moment? So today, we're going to set aside the panic. We're going to ignore the clickbait telling you silver is going to zero and the influencers screaming that this is a conspiracy. We are going to look at the cold, hard data. We're going to deconstruct the nomination of Kevin Warsh to the Federal Reserve, the mechanics of these algorithmic margin calls, and the sudden, violent resurgence of the US dollar. This is the anatomy of the crash of 2026. But before we get into the why, we really need to understand the what. Precision matters here, so let's look at the tape from Friday, January 30th. Coming into the week, silver futures were actually trading pretty comfortably. The market had been in this strong uptrend since late 2025, driven by industrial demand from the solar sector and speculation on rate cuts. On Thursday evening, the March 2026 contract closed at $34.50 per ounce. Everything looked fine. Friday morning, the Asian session was quiet. London opened and we saw some softness drifting down to roughly 33.80. Nothing alarming, just standard volatility, right? Then came 8:30 a.m. in New York. At 8:30 a.m., the Bureau of Economic Analysis released the latest PCE inflation data, which came in hotter than expected, and that coincided exactly with the official White House announcement regarding the Fed chair nomination. The reaction was instantaneous. In the first 15 minutes of New York trading, silver plummeted from $33.80 to $30 flat. That is a 10% move in 15 minutes. Now, in a normal market, buyers would step in at $30. We call this buying the dip, but on Friday, there were no buyers. The bid simply vanished. The screen went blank. By 11:30 a.m., amidst a cascade of forced liquidations, which we'll get to in a minute, the price hit an intraday low of $24.84. Let's just pause and do the math on that. From Thursday's close of $34.50 to the Friday low of $24.84. That is a collapse of 28%. To put that in context, if you held a standard futures contract, let's talk about what that actually means for your bank account. For those of you who don't trade futures, here is how it works. The standard silver contract on the COMEX represents 5,000 ounces of silver. At $34.50 an ounce, one contract is worth, about $172,000? Something like that. But traders don't put up the full amount. They use margin. They might only put up $12,000 of their own cash to control that massive contract. This is roughly 14 to 1 leverage. So when silver drops $1, the contract loses $5,000 in value. On Friday, silver dropped nearly $10. That is a loss of $50,000 per contract. And remember, the trader only put up $12,000. Within the first hour, their entire $12,000 was gone. Poof. And they now owed the brokerage an additional $38,000 per contract. This is what we call going debit. It's the nightmare scenario. This brings us to the trading volume. The CME Group, which runs the exchange, reported preliminary volume figures that honestly shatter modern records. Over 300,000 contracts changed hands on Friday. That represents 1.5 billion ounces of silver. That is nearly twice the annual global mining production of silver traded in a single day. Think about that. 2 years worth of every mine in Mexico, Peru, and China combined traded electronically in 6 hours. Why does this volume matter? Well, it confirms that this wasn't just a few hedge funds changing their minds. This was a liquidity event. It means that for every seller desperate to get out, the price had to drop significantly just to find a buyer willing to take the risk. When we compare this to other crashes, it really stands out. I mean, back in April 2013, when gold collapsed, silver fell about 11 or 12%. In March 2020, during the onset of the pandemic, silver fell violently, sure, but that was over the course of a week, not a single morning. To find a 28% single-day candle, you really do have to go back to the Hunt Brothers era of 1980. But there's a critical difference here. In 1980, the price was $48. In 2026, we were at $34. The percentage is similar, but the market structure is completely different. In 1980, humans were shouting orders in a pit, waving their arms. There was friction. It took time to execute a trade. Today, algorithms execute in microseconds. This speed means that when things break, they break faster than human reaction time. So we have established the magnitude. A 28% drop, record volume, and massive destruction of leveraged capital. Now, we must ask, what sparked it? What piece of news could possibly justify a 28% repricing of a global commodity? It starts in Washington, D.C., with a single name. See, markets operate on expectations. The price of silver today is not based on the supply and demand of today. It is based on what the market thinks supply and demand will look like 6 months from now. For the last 2 years, the consensus trade, the story everyone believed, was that the Federal Reserve had defeated inflation. The market believed the Fed would cut interest rates, print money to support the bond market, and generally allow the economy to run hot. This soft landing narrative, it's the perfect environment for precious metals. If money is cheap and plentiful, you buy hard assets like silver. On Friday morning, that narrative was taken out back and shot. The nomination of Kevin Warsh to replace the current Federal Reserve chair sent a shockwave through Wall Street. Now, to the general public, one Fed chair might look like another, but to the bond market, Kevin Warsh represents a specific ideology. Warsh is a hawk. During his previous time at the Fed and in his private sector writings, Warsh has been a vocal critic of easy money. He has criticized the Fed's balance sheet expansion. He has argued that the Fed should not bail out asset bubbles. His nomination signals that the new administration wants a return to sound money. Now, why is sound money bad for silver? It sounds counterintuitive, right? Shouldn't silver investors like sound money? Ideally, yes. But in the short term, financial mathematics takes over, and we have to talk about real yields. I know, real yields sounds boring, but stick with me. This is arguably the most important concept in this entire video. If you understand real yields, you understand 90% of gold and silver price movements. Silver is a non-yielding asset. It pays no interest. It pays no dividends. If you hold a 100-ounce bar of silver for 10 years, at the end of 10 years, you still just have 100 ounces of silver. It hasn't grown. It hasn't paid you rent. Contrast that with a U.S. government bond. If you buy a bond, the government pays you interest, let's say 4% a year. Now, imagine the real yield rises. This means the return on bonds after inflation gets better. If Kevin Warsh is in charge, the market assumes he will keep interest rates high to crush inflation. On Friday, immediately following the nomination, the yield on the 10-year Treasury spiked. It shot up because traders realized, wait a minute, Warsh isn't going to cut rates to save the stock market. He's going to keep rates high. Suddenly, bonds became very attractive, and if bonds are attractive, silver is ugly. Why hold a risky metal that pays zero when you can hold a risk-free government bond that pays a high Warsh-guaranteed interest rate? Institutional investors, pension funds, endowments, sovereign wealth funds, they don't trade on emotion. They trade on asset allocation models. When the yield on bonds spikes, their computer models automatically tell them, sell non-yielding assets, buy bonds. Silver is the quintessential non-yielding asset. So, the first wave of selling on Friday morning wasn't panic. It was a rational mathematical reallocation of capital based on the Warsh Pivot. The market was repricing the cost of money. We have seen this movie before. In the late 1970s, inflation was out of control. Silver and gold were skyrocketing. Then Paul Volcker took over the Fed. He jacked up interest rates to nearly 20%. And what happened to silver? It crashed. Because who wants silver when the bank pays you 20% on your cash? The market looks at Kevin Warsh and sees the ghost of Paul Volcker. They fear that the era of free money is over. And if free money is over, the speculative premium on silver has to vanish. However, and this is a big however, a change in Fed share, while significant, usually causes a 2% or a 3% drop. Maybe 5% if the market is really surprised. It does not explain a 28% crash. Macroeconomics lit the match. But something else caused the explosion. To understand the velocity of the move, we have to look away from the Fed and look at the market positioning. We have to talk about the long squeeze and the algorithmic cascade. Because on Friday, the robots weren't looking at Kevin Warsh, they were looking at each other. To understand why the market fell 28% in a single day, we have to look at what happened before that day. From October 2025 through January 2026, silver went on a historic run. It was a perfect storm of bullishness. Industrial demand was up, the soft landing narrative was strong, and retail investors were piling in. By mid-January, the market exhibited what professional traders call a crowded trade. Imagine a boat. When everyone is sitting on one side, the boat lists. If everyone is long, meaning they have bought silver expecting it to go up, there's no one left to buy. The buying power is exhausted. When a trade is crowded, the market becomes fragile. It doesn't take a sledgehammer to knock it over. A feather will do. Kevin Warsh was the sledgehammer, but the market was already leaning over the edge. When the Warsh news hit and prices ticked down, it triggered the machines. Today, the vast majority of futures volume is transacted by high-frequency trading algorithms and commodity trading advisors. These are trend-following bots. They don't care about the Fed. They don't care about solar panels. They care about momentum. For 3 months, the momentum was up, so they bought. On Friday at 8:30 a.m., the momentum flipped to down. This is where we talk about the stop-loss cascade. Every responsible trader sets a stop-loss, a price level where they admit they were wrong and sell automatically to prevent further losses. Because so many people bought in the same price range during January, their stop-losses were clustered together. As the price fell through 33.50, thousands of sell orders triggered instantly. This wave of selling pushed the price down to 33. Click. That triggered the next wave of stop losses. Click. The next wave. It's like a row of dominoes. Once the first one falls, gravity does the rest. The selling creates the lower prices, which triggers more selling. But that's just the stops. The real violence? That came from the margin calls. I want to explain the mechanics of a forced liquidation, because this is what turns a correction into a crash. Futures trading uses leverage. You borrow money to control a large amount of silver. Let's say a hedge fund is leveraged 10 to 1. If silver drops 5%, that fund has lost 50% of its equity. If silver drops 10%, that fund is wiped out. 0. On Friday morning, as silver plummeted past the 5% and 8% marks, risk management desks at major banks lit up red. The computers realized that if the price dropped any further, their clients wouldn't be able to pay them back. So the banks didn't ask nicely. They issued margin calls. And when the clients couldn't wire millions of dollars in seconds, because who can, the bank's computers took over. The liquidation engines fired market orders. A market order says, I don't care what the price is, get me out now. When you have thousands of market orders hitting a market with no buyers, the price free falls. It gaps down. It can jump from 30 to 29 to 28 in the blink of an eye. This is what we saw between 9 a.m. and 10 a.m. It was a long squeeze. Bullish traders being forced to sell their positions just to survive. It is important to note, this phase of the crash had nothing to do with the fundamental value of silver. It wasn't about mining supply or industrial demand. It was purely mechanical. It was a liquidity event. The exit door was small, and everyone tried to run through it at the exact same second. And here's the kicker. While everyone was rushing for the exit, they were also rushing toward something else. They were rushing toward the US dollar. You cannot analyze commodities in a vacuum. You have to look at the currency they are priced in. When we say the price of silver is $30, what we are really saying is 1 ounce of silver exchanges for 30 US dollars. It is a ratio, silver over dollars. If the bottom number, the dollar, gets stronger, the ratio goes down. Even if silver itself doesn't change, a stronger dollar makes the price label lower. On January 30th, the US dollar index staged a massive rally. Why? 2 reasons. First, remember, cause number 1, Kevin Warsh. Higher interest rates make the dollar more attractive to global investors. If I can get a higher yield in US Treasury bills, I sell euros, I sell yen, and I buy dollars. This demand pushes the value of the dollar up. But the second reason is the safe haven paradox. This is one of the most confusing things for new investors. Imagine the US stock market is crashing. There's fear in the streets. You would think people would sell the US dollar, right? Wrong. When there is fear in global markets, even if that fear originates in the US, capital flees to the deepest, most liquid market in the world, the US Treasury market. On Friday, as silver collapsed and volatility spiked, funds around the world moved into risk-off mode. They sold risky assets and bought the safest asset, cash. This created a feedback loop. 1, silver falls, causing panic. 2, panic causes people to buy dollars. 3, a stronger dollar makes silver cheaper in nominal terms. 4, silver falls further. We also have to consider the international buyer. If you are a jewelry manufacturer in India or an electronics maker in Germany, you buy silver with your local currency. If the dollar spikes 2% in a day, silver becomes 2% more expensive for you, even if the price hasn't moved. So you stop buying. Global demand dries up exactly when the market needs it most. So the 28% crash wasn't just about silver being weak, it was about the dollar being incredibly violently strong. It was a wrecking ball moving through the commodities complex. Now, I know what many of you are thinking. A 28% drop, manipulated markets, margin calls. It sounds familiar, right? It sounds like 1980. And let's address the elephant in the room. You cannot talk about a silver crash without invoking the ghosts of Nelson Bunker Hunt and William Herbert Hunt. In 1979 and 1980, these Texas oil tycoons attempted to corner the silver market. They bought physical bars, they bought futures. They essentially tried to own the entire global supply. They drove the price from $6 to nearly $50. When the regulators stepped in and changed the margin rules, forcing buyers to put up more cash, the Hunt brothers couldn't pay. The bubble burst. On Silver Thursday, March 27, 1980, silver collapsed 50% from its peak. It is tempting to draw a direct line between then and now, but there are fundamental differences that we must understand to be financially literate. Difference number one, the cause. 1980 was a concentrated scheme by a specific group of individuals. It was a manipulation of supply. 2026 appears to be a macroeconomic event. It was driven by Federal Reserve policy and broad market mechanics. There is currently no evidence of a single entity trying to corner the market. In fact, the data suggests broad-based selling. Difference number two, the market structure. In 1980, the market was opaque. No one knew exactly how much the Hunts owned until it was too late. Today, we have the CFTC's Commitment of Traders reports. We have real-time data. While not perfect, the market is far more transparent. But the biggest difference, and the one that honestly saved us from total ruin on Friday, is circuit breakers. In 1980, the price just fell until there were no bids. It was a free fall. Today, the exchanges have rules. If the price drops by a certain percentage, trading is paused for 15 minutes. On Friday, we hit limit down multiple times. You might see these halts as annoying, but they serve a critical function. They allow humans to step in front of the algorithms. They allow liquidity to replenish. They allow cooler heads to prevail. Without these modern safety valves, the 28% drop could have easily been 40% or 50%. The machinery of the market bent, but it did not break. The clearinghouses remained solvent. The system functioned as designed, even under extreme stress. So, while the chart looks like 1980, the mechanics are strictly 2026. This was a modern, high-speed, algorithmic liquidation event. We have covered the why, we have covered the how, the Warsh nomination, the algo squeeze, the dollar spike. But what does this mean for the plumbing of the market? How exactly did the trades execute in the microseconds between the drops? And what happened to the ETFs that millions of regular people hold? In the final section here, we're going to look at the market microstructure, the hidden gears of the financial system, and then we will discuss what this means for the global economy, and most importantly, for you. We have talked about the macro reasons, the Fed, the dollar, the hype. Now we need to look under the hood at the micro reasons. We need to talk about the plumbing of the financial system. Why did the price fall so fast? Why were there gaps where no trading happened at all? The answer lies in something called a liquidity gap. In a healthy market, the order book is thick. For every seller at $30, there is a buyer at $29.99, $29.98, and so on. The price moves smoothly, cent by cent. But on Friday, the bids evaporated. Market makers, the firms paid to provide liquidity, are programmed to pull back when volatility exceeds a certain threshold. They enter survival mode. When the Warsh news hit and the selling started, the algorithms providing buy orders simply turned off. They stepped away. So a seller trying to exit at $30 might not find a buyer until $29.50. The price gaps down 50 cents in a millisecond. Then the next buyer is at 29, another gap. These air pockets accelerated the crash. It wasn't that people agreed silver was worth 28% less. It was that there was literally no one standing there to say otherwise. Then we have the ETF effect. Millions of retail investors do not own futures. They own ETFs, like SLV. This creates a unique feedback loop. When retail investors panic, they sell their SLV shares on the stock market. If the price of SLV drops below the value of the silver it holds, big banks, called authorized participants, step in. They buy the undervalued SLV shares, exchange them for the physical silver backing them, and then sell that silver into the futures market to lock in a profit. This is arbitrage. It keeps the ETF price accurate. But on Friday, it acted as a force multiplier. Panic in the stock market mechanically forced massive selling in the futures market. The tail was wagging the dog. Finally, we have dealer positioning, specifically something called short gamma. I will spare you the calculus, but here is the simple version. The banks that sell options to speculators often have to hedge their risk. When they are short gamma, the math forces them to sell more as the price drops to stay neutral. As silver fell, the dealer's own risk models forced them to sell into the crash. They weren't speculating, they were just following the hedging rules. But when everyone follows the same rule at the same time, the result is an avalanche. So the dust is settled. Silver is down 28%, the charts are broken. What happens next in the real world? First, let's look at the miners. Major primary silver miners saw their stock prices collapse on Friday, some dropping 30 or 40%. For a mine, the all-in sustaining cost is the break-even price to pull an ounce of silver out of the ground. For many mines, that number is around $18 to $22. At $34 silver, these mines were printing money. At $24 silver, margins are crushed. If the price stays suppressed, we will see exploration budgets cut. We will see expansion projects put on hold. Ironically, this crash plants the seeds for the next bull market. Lower prices today mean less supply tomorrow. But tomorrow in mining takes 5 years. For the industrial sector, Friday was a gift. Solar panel manufacturers, electric vehicle companies, and electronics producers just saw one of their key input costs drop by a quarter. In a world fighting inflation, this is actually a deflationary impulse. It could make solar panels marginally cheaper to produce in 2026. But the strangest ripple effect is happening right now at your local coin shop. We are already seeing a massive disconnect between the spot price, the paper price, and the physical price. When spot prices crash this hard, physical dealers panic. They don't want to sell their inventory at a loss. So premiums skyrocket. You might look at the screen and see silver at 24, but try to buy an ounce in your hand, and you might pay 35 or 40. The paper market crashed. The physical market just froze. This decoupling is common during crashes. It reflects a loss of confidence in the paper price discovery mechanism. It will take weeks for these two markets to realign. We have spent 45 minutes dissecting the carnage. The Warsh nomination, the algo squeeze, the liquidity gaps. But if you're watching this, you probably care about one thing. What does this mean for my money? Let's be crystal clear here. I cannot give you financial advice. I don't know your portfolio, I don't know your goals, and I don't know your risk tolerance. But I can give you financial education. And Friday offered 3 brutal lessons that every investor must learn. Lesson 1. Volatility is the price of admission. Commodities are not stocks. They are not bonds. They are raw materials subject to the whims of weather, geopolitics, and central banks. If you want the potential upside of silver, the moonshot, you must accept the downside. You cannot have the 50% rally without the risk of the 28% crash. They are two sides of the same coin. If you cannot stomach a 30% drop in a day, you simply should not have significant exposure to unhedged commodities. That is not an insult. It is a risk profile reality check. Lesson 2. The math of ruin. This is the most dangerous math in investing. If you lose 50% of your money, you don't need a 50% gain to get back to even. You need a 100% gain. This is why stop losses and risk management are not optional. They are survival tools. The traders who survived Friday were the ones who took a small loss early. The ones who got wiped out were the ones who held on, hoping it would turn around or worse, added to their position on the way down. Lesson 3. Diversification is your armor. If silver was 5% of your portfolio on Friday, you had a bad day. You lost maybe 1.5% of your total net worth. It hurts, but life goes on. If silver was 50% or 100% of your portfolio, Friday was a catastrophe. True wealth is preserved through diversification. It is boring. It is unsexy, but it works. Events like the Warsh crash are black swans, rare, unpredictable, high-impact events. You cannot predict them. You can only prepare for them by not having all your eggs in one volatile basket. For those looking to learn more, look, do not rely on YouTube comments or Twitter gurus. Go to the source. Read the CFTC's educational materials on futures trading. Read the CME Group's guides on risk management. Study market history. Read about 1980. Read about 2008. The market is a tuition-based learning environment. Friday was a very expensive lecture. Make sure you actually learned the lesson so you don't have to pay the tuition again. January 30th, 2026 will go down in history. It will be studied in finance textbooks alongside Black Monday and the flash crash. It was the day the silver market reminded us that gravity still exists and that when the Federal Reserve moves, the world shakes. The market will recover. It always does. Price discovery will return. The miners will keep digging. The solar panels will keep being built. But the psychological scar of this volatility will last for a long time. Markets are not just numbers. They're the collective psychology of millions of human beings. Greed, fear, hope, and panic, expressed in real time. Friday was a day of fear. As we move into February, we look to see if reason returns. Thank you for trusting us with your time during this chaotic week. We will continue to monitor the situation, specifically the upcoming confirmation hearings for Kevin Warsh and the response from the mining sector. If you found this breakdown helpful, consider sharing it with someone who might be trying to make sense of the noise. Stay curious, stay skeptical, and please manage your risk. Good night.